Hello and welcome to Welcome Home Radio. The waters in the mortgage industry can be pretty muddy, whether it's investing, leasing, renting, home insurance, or myths and misconceptions. Welcome Home Radio has the answers for you, the consumer. And now, to help you make the right home buying decision for you and your family, here are your hosts.
Good morning, everybody, and welcome to Welcome Home Radio. It's October 12th, 2022, and today we're going to talk about interest rates, what's going on in the world of interest rates today. Thom, good morning. David, good morning.
Good morning.
David Caviness is with us with David Caviness Wealth. We're going to talk again interest rates and other things about money. I think it'll be a very interesting conversation. Thom, how's your morning going, bud?
Not too bad at all. Just enjoying the wonderful end of my vacation. I've had a week and a half off, and it's been like, maybe this is what retirement's supposed to feel like.
Well, let's hope we all get there. That would be wonderful.
Well, David takes, Mr. Caviness with us today. One of the reasons I invited him is he's so knowledgeable in the field of investment. He's a planner individual. I'll let him actually introduce himself here in a little bit in just a second, but I wanted to have him on because I felt like our take on the market and where we're headed and what we see. And at this point, looking back, hindsight's always 2020, which is great. I pulled everything out of the market, last year at the end of December, and I haven't had anything losing money this year. Oh, now wait, Tom's nose, it's getting longer and longer and longer. But I'm hoping David's help here today will kind of assuage some of us with regards to expectations and interest rates increase, because we understand, of course, that the mortgage market has really dried up as far as, and keep in mind, when they talk about the mortgage market, they're talking about applications for refinances as well. Very few people want to refinance from a 3% interest rate to a 7% interest rate. So that's kind of unusual. So the idea here is to kind of get a grasp of maybe perhaps when we will see this change, when we'll see things normalize a little bit, and what the market is doing itself today. David, introduce yourself a little bit as far as background and tell the folks how they can get hold of you as well.
Sure. Yeah. So, as you guys have already said, I'm David Caviness. I am a certified financial planner, and I'm owner and founder of Caviness Wealth Management. We're a state registered investment advisor here in Texas. And, I've been, this is my 22nd year total in the industry, and almost 16 since I went out and started my own firm. So it's been quite the roller coaster since I got started in 2000. We've experienced quite a few of these ups and downs in the market, as you guys know, through the years, and survived 2008, and now we're kind of going through this phase. I'm honored that you guys, Thom, invited me to be on the show today, and happy to join you guys.
Well, I tell you, let's get right into it. You said you've been in the business 22 years, 16 your own company. What are you making of this economy?
Yes.
Since you've been through 2006, 7, 8, 9, 10. You saw a lot of people that had a lot lose a lot. You saw them get some of it back. Some never did recover. And now you got a whole generation going through their very first economic downturn. Can you help our audience out with what you see and what you've dealt with over the last 15 years or so?
Yeah, I mean, we go through a lot of ups and downs. I think, first and foremost, I don't see at this point that we're in an 2008 type situation, which when you're going through it, at the time, it was absolutely brutal. I think investor behavior is the one thing we talk about a lot with our clients, and how do you act and react, and what should you do? I believe that everybody should have a plan, a long-term plan that they are adjusting when things get a little rough, like it is now. If if you're having a hard time sleeping at night, then that says we need to kind of reassess where we are from a risk standpoint. But I think the best course of action most of the time is to stick to your plan, and sometimes that's the hardest thing to do. We let the emotions take over. There's always a reason not to stay with your plan, not to stay invested, and not to stay the course. But I think you're rewarded in the long run when you do.
Yeah, Thom, I would agree with that.
That's the toughest
Long-run
thing. Yeah.
The long run thing I think is very important. And there are, I guess, a generation out there now that are getting started, maybe been in it 8-10 years working. They've seen their 401ks kind of tumble down a little. I'm sure they're going through the same emotions that the other generations did when they lost money in their 401k. So again, reiterate that advice you would give somebody watching this show that is on the cusp of, am I doing what's right? I really don't have anybody professionally helping me, but my dad or my grandpa or my aunt or uncle have really given me good advice. What do I do now? Can you follow up on that a little bit more? Is it normal for people to have that feeling?
Oh, absolutely. I think that's the normal part of investing. And, I would take a step further and tell everybody to keep things in perspective as well. The advice you're getting from, your parents or uncle or your next door neighbor who's always got the hot stock tip, remember that their situation is always different than your situation. And, you really need to look, when you start thinking about your portfolios, whether your 401k or, just your general investment account, you really have to look at it through a lens of your own personal situation. And I think, a lot of times we start digging around on the internet or, we're on social media and everybody's got a different opinion on what you should be doing or how to do it, but it's not always relatable to, your goals. And that's the important thing is, what are your financial goals? How are you doing in relation to, meeting those goals, being on track for those goals, and what tweaks and changes do you need to make for that? I think once you kind of scale back and you really look at your goals and your plan and what your roadmap is essentially, then, I think the markets like we're going through right now become a little more, I want to say a little more easier, but that's nothing's easy when you're down, 20, 30%, but manageable. Yeah, that's a better way to put it. I think navigatable, you can navigate, these bumps in the market a lot easier when you know what it is, you're trying to achieve and what it's going to take to get there. I think,
well, you touched on something that I think is really interesting too, is that a lot of folks, in the day didn't have to deal with, but today, with so much instant information, anxiety, you got the social media, you got the internet, you got 24/7 news. I think people's brains have more, there's more on your brain now than there's ever been, I think, in today's world. And I wonder how that affects the wealth management business and the people that you're talking to with some of the issues they come to you with.
Yeah, and you cut out a little bit, little glitching at the beginning of that, but I think I caught the gist of what you're saying. I think having the knowledge, the information at your fingertips, it's really changed even from when I got in the business, in 2000, 2001. The information is certainly out there. It's, how do you take that information and make it, applicable to yourself, right, in your situation, and, bring in your risk tolerance and your goals into effect with it. It's I think it's made it a little more trickier, for the individual investor, certainly to, go through any kind of market disruption like we have. And you mentioned it earlier too. I think we've got a whole set of investors that really have just gotten started over the last few years. And, aside from, that little blip we had, back with COVID, it's been a pretty pretty lofty time to be investing in something we saw, again, in the late 90s leading up to the Y2K bust, where it didn't matter what you were buying. If you bought it, it was going up, and you get real comfortable as investors when that's happening. And then now that things are down 20-30%, you start having a little different attitude towards everything.
Well, the title of this show has to do with interest rates, and we are now seeing interest rates 7%. Haven't seen that in probably 15 years. I don't know, 10. I don't know exactly, but it's been a long time. So when you're starting work and you have a good job and things are going well and you're investing right, now it's time to buy that home and you're up against, well, gosh, did we wait too long, or what's going on? Now it's 7%. If we would have bought last year, it was 3.5%. So do you see any of that in your wealth management business, or how do you deal with people with issues like that? Because as a realtor out in the field, I guarantee you I deal with that weekly. And one of my big things out there is, marry the house and, just rent the rate and then get rid of the landlord. Tom's a landlord, not against Tom, but trying to get people to realize that.
Are you sure?
Yeah, I'm pretty sure.
Okay.
You can divorce the rate later. Hopefully it goes down at some point. The way the world's been, it's been up and it's been down. And I'll tell you another thing that folks are tired of hearing, especially the newer generations, is I'm tired of hearing about my mom and dad and my grandpa and grandma's first house was 14%. And it's only 7% now.
Wow. That was my grandpa? Jeez.
Well, it depends how old you are. If you're 25, your grandpa's probably telling you that. So it's a real issue. I hear it weekly. Yeah. I'm sure you hear it in your business. How are you as a wealth manager? What are you telling your clients?
I think it definitely is a struggle. I mean, and I'm thinking you guys, you hit it right on the head. I think in a very short time, we've gone from, just sub 3%, pushing 7% from a, mortgage rate. And,
they may not be
now
done.
You're looking at, I don't think we're done either. I think, there's probably still a little more to go here. You look at it, just if you take the median home price here in the Dallas-Fort Worth area and a 30-year mortgage now, from a cash flow standpoint, your just your P&I you're up almost 50% from what it would have been a year ago. And so now it's got to really come back to your cash flow planning. I think you hit it, made the best point, is, if rates come back down, you can refinance out. But, the conversations we're having is, do we put more money down? Do we bring more money to the table and, bring our rate down or our payment down that way? And I think that's where we've got to look at, I think we got to take a more holistic approach. We're looking at cash flow with clients and where does it make sense in your budget. That rent versus buy conversation that's always out there, I think, is more prevalent these days than they have been in many years, because it's been so cheap to buy a house. And as you know, prices keep going up. Doesn't matter how long you live there, you can move every 2 or 3 years almost, and be okay. But it's a lot different now, and that's a tougher conversation especially for our younger families that are, early professionals starting a family and still trying to figure out where they're going to be in life.
Yeah, and I think home purchasing can be so regional too. Yesterday a stat came out, 300 people a day moving to the Dallas-Fort Worth area. And that has been fairly consistent for quite a while. I don't know how many people are moving to Cleveland every day, or, Connecticut or whatever. But I know here, there's only so many houses still. And some of the folks that were going to either make a move up or down are not moving. So they're tying up some inventory there. But houses are on the market a little longer. There tends to be a little bit better I think, choice for buyers. But the VA buyers and the FHA buyers, many who don't have a lot of cash, they're not, as well equipped as maybe a conventional buyer is. That's a whole nother issue going on. And so it's been it's been quite a transition from last year to this year in the real estate business, lending also, I'm sure. Thom, I know you teach and you're one of the best at that in very many subjects. But as a manager of your wealth, so to speak, in your housing that you own and you lease out, how is that going with your rents? How are the people that are renting your homes? Are they staying there longer? Can you tell yet, or are they actually moving out to buy, or have they just put that all away and they're just thanking God they have you in the house they're living in?
Well, I will just be frank that most of my tenants now I've got an average of about 7 years for every tenant that I've got, meaning that, my tenants are really long term. And that's because I keep the rents affordable. But this year I'm paying my taxes right now, and I'm just going through and I'm like, I've got to raise my rents next year. There's going to be a fairly substantial increase because not only did the taxes go up, but the insurance went up as well substantially. You got to keep in mind, Texas is one of the most expensive places to have insurance. And if you combine it with our tax rate, we're number one in the U.S. with regards to how much we pay. Although I think Florida is going to catch up with us pretty quickly here, it sounds like. So the reality of owning a home, is tougher. I've got one of my tenants that's, trying to get qualified for a loan. They've got the same issues they had when they moved in 8 years ago, though, on the credit. So I pointed out to him, if you're going to heal, if you're going to make this happen, I'm giving you the ability to do that by keeping your rents low. But next year, I got to move them up to market or closer to market so I can see that. And I feel for all my tenants with regards to they try to take care of the properties. They don't bug me a lot, which is good. But at the same time, I also realize that this has been an opportunity. I've tried to afford them to get out of the rental situation if they possibly can. And so I think it's everybody's own personal initiative. And I've tried to advise them with regards to things that they need to, get as straight as they possibly can in order to move to the next spot in life, which might be owning their own home. But
the iBuyer thing really got going a couple of years ago. You had big money asset management companies coming in, stock exchange companies coming in, buying homes, and a lot of them didn't do very well when the market changed. Now you have a trend, and I'm sure David's aware of this, that lease-to-own neighborhoods are being built. National home builders are building lease-to-own neighborhoods, and we have 3 in DFW right now. And that was just as of a couple of weeks ago when I was reading about it, maybe more, but you can only rent in these neighborhoods. You cannot buy the homes. And to me, it's an interesting trend. Things always change in real estate. David, have you kind of seen any of that? And have any of your clients talked to you about that at all? Or is it too new yet, or what?
Yeah, I think that's still too new. I'm aware of them, but in terms of clients and conversations, we haven't really had any of those yet. But I do see that, that's probably coming, in a relatively short period of time now.
Well, it leads to the rent versus own thing to me. And I think eventually it gets into your business for sure, wealth management.
Sure.
But I don't know how many of your clients rent versus own. I was kind of maybe thinking the majority of your clients own homes, or at least buy them. Is that true?
Yeah, I think that's very accurate. I mean, I've got some that rent or lease, but for the most part, most of our clients are homeowners. So
here's where I was going with this, David. I see on some of the reading I do, and also LinkedIn I see, which I know you can take that for whichever way it is, but you see people whose titles are wealth managers, saying renting might be better for you than owning. And they leave a question mark. Now, I'm sure they're trying to drive their business, get people to call them and ask. But I've seen that more in the last 6 months than I have, probably in the last 10 years. So I was just wondering if it's starting to creep in, or if that just early advertising, call me, I want to manage your wealth, that kind of thing.
Yeah. Well, I mean, I think, let's be honest, part of that is generating activity and content. You probably put 10 of us in a room and you'll get 10 different answers on, what's the best route to go. And it still, to me, comes back to, what works best for your personal situation. I don't think there's a blanket answer for that question at all. I mean, you got to look at time frame as well. If somebody's here on a temporary relocation, then, you can easily make that argument of, you want to rent and not own, and the additional costs there. But I don't get into too much of the back and forth on social media with the rent versus own, because I think that's a very specific issue for each individual, instead of just a blanket, you're better to always to rent, which some people will say that, and some are on the other side of the fence.
Yeah, I agree. I think Blair and I are involved with that every day.
That big.
Yeah.
I mean, I think it is, it's tough. And
what are wealth managers telling their clients as far as interest rates in the future? I know you can't predict anything. We don't know if a bomb's going to go off in Russia or whatever. We can't predict things in general, but you do give advice based on history and based on your knowledge, and I'm sure you're keeping up with the Federal Reserve. So in general, we're thinking, I personally think interest rates are going to continue up still a little bit. I don't know how much, but is that kind of your feeling too?
It is. I think the crystal ball is still a little murky here, but it appears all indication, from the Fed is they're maintaining this course. And, we've got to see it, probably be interesting later this week to see what the inflation numbers look like after we've had, several months now, pretty strong, interest rate hikes by the Fed. So I don't see that, they're going to change course before end of the year, unless we do get, some kind of black swan event or something that's just not on the horizon to force them to change course or even pause for a minute. But, I think, for all betting people here and putting chips on the table, it would certainly look like, through year end, we're still going to continue with some rate hikes.
And Thom, I'm pretty sure you're agreeing with that. You're kind of thinking that as well.
No, I think they're going to drop by 3% here in the next 3 months. No. Just
wow,
saying.
we have a hot sports opinion.
Got to start a little controversy here somehow.
Put you on the ticket.
Well, Ben Bernanke won the Nobel Peace Prize today, so I was always kind of thinking, well, let me call Ben and ask him what's going to go on. I don't know if David remembers this. David and I both served on a school board together, but about 5 years ago, they have an annual conference, the TASB conference, here in Dallas. And I was able to go and actually listen to Rob Kaplan speak at that time. And I was in a big cavernous room with about 8 other school board members, because he talked right at lunchtime. And so everybody had gone to lunch. And it was basically me being able to ask Rob Kaplan, why in the heck were interest rates still at 0% when we had an economy that was doing really well, chugging along, and and he didn't give us any room. And I made the point with him, and he said, "Are you the only one that's going to ask questions?" And I said, "It's you and me, Rob, because I'm the only one here during the Q&A." And I think he finally cut off Q&A because I asked so many darn questions. But I remember this so distinctly, being able to ask him these specific questions about why is the Fed not raising rates at the time. and they're always that the Fed tends to not be. Oftentimes, it's not proactive, and that's the frustrating part with interest rates. I think is that they're reactive, and this has always been the case. Is it's a reactive piece. So when you see this next rate increase, which the Fed meets in November again, Dave, I guess it is.
I believe that's right. Yeah.
That'll be their last meeting before the end of the year. They'll increase it another 0.75%. But I also predict that in October, they're going to see some real slowing in our economy. And the weird thing about all this is that we're still not looking at the fact that in this economy, we've got such good employment numbers that it's not. It can't be counted as a true recession, even though it's still, I feel like Mike Tyson's hit me twice in the head pretty hard already. And so I'm sitting here going, okay, we're not in a recession, but the Fed's still raising these rates. I think this would probably foreseeably be the last increase, probably. It'll definitely be the last one for the year, but probably the last one for, maybe a good quarter or so. So I just anticipate that there's kind of a end to this tunnel at this point, and I'm seeing some of the light here at the end, because I know when I go to the store and see $4 a gallon milk and $3 a gallon, $3 a dozen eggs, that I know most people are probably going, whoa, where's the deal on this, Thom? When's this going to happen? But coming back to the Fed and again, that interest rate aspect, the interest rates, of course, technically have rarely ever affected mortgage rates. And so this is kind of a perfect storm, because the Fed got out of buying bonds, which they should have been out of 5 or 6 years ago as well. Another question I asked Rob Kaplan at the time, why are you still so highly invested in our mortgage rates and artificially keeping them low? And it built in this false sense of security that we're getting more into a normalized situation with interest rates. And I wouldn't be surprised to see them stick around 6%. I mean, 6.5% for a good year or so while investors start filling their buckets. But anybody that's watched the markets know that the investors are not even giving par rates anymore. It costs you a point just about on any rate that you want to get nowadays, which is an unusual tact in the marketplace as well. So this is all these kind of things. We're going to have to see some settling in the marketplace, and it sure doesn't help to have the potential of a nuclear war on the horizon. And it's always, people infighting. I think it's time for us to start thinking more along the lines of trying to come together and work these things out and work people into a better position to be able to do this. I wanted to ask Dave on the interest rate thing, as far as that goes, where you might be investing as far as, a good interest rate investment type deal, CDs and that type of deal. I know I went out and bought my inflation treasuries, my tips, and bought my little $10,000 worth of those at 9%. I thought, well, that's not a bad idea. Is there any other place that might be good place to go with your monies from that standpoint? Yeah.
I mean, I think that's the toughest thing right now is, how do you navigate the bond market? And, typically that's your more conservative investors that have historically been, invested in, either partially or heavily into, that side of the equation. And this year is just been brutal, and I think for many years it's forced your conservative investors to be, even a little more, tilted into equities than where they historically would have been, or their comfort level has been, just to generate, the added interest and dividend income. But, I think it's still, what we're advising here is I think it certainly could still be a little bit early in the bond market. The I bonds have been a good place, to generate some yields with interest. And, now that we're seeing treasuries, in the short term, 3+%, it's been, an area to start considering parking some money at, and maybe even laddering, some of those bonds over, a short time period, and trying to wait out, all the
And so Dave just said, I don't have the technology to keep it up.
Yeah. But Thom, you said something earlier that I think is really interesting when you said, and I think it'll come back to 6%. And to me, there's a new normal with every high, right? Things go up,
Sure.
up, up, then they come down. And when they come down, that in itself creates a market.
Yeah.
Right? So if they do go up, 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 and they come down to 5%, 6%, now we've lowered the rates. We've got a new normal, and people suddenly feel comfortable, like, oh my gosh, it's a good time to buy something. So I think that's part of the equation here with
and what the offset, of course, and what, as you alluded to earlier, about pricing, that is something that's reflected more and more so in the interest rate adjustments, that as the interest rates go up, and I remember when rates were 14 and 15%, Grandpa, but when they were, the thing that I remember so much about that interest rate increase was the fact that pricing had to adjust downward, because people still, it's the affordability aspect of what's so important. And we don't look at affordability calculations. David's been alluding to that pretty much throughout the conversation here, but something incredibly important to understand is that as a seller, I may have missed my window to sell it with 10 people standing in a row waiting to outbid each other for my house. I may be lucky to get one bid in the first 30, 60, 90 days, which tends to be happening, it seems like, more and more with regards to the marketplace. And
that's exactly right. And, people, when they're doing their marketing, and lenders are really good at this, they have the people that they've done business with, and they send out a monthly update on interest rates and what their houses are worth. And I've got several clients who are saying, gosh, we bought that house at the, wrong time.
At the wrong time. That's another thing that a lot of people are looking at here in the next 2 years as they go into refinance and they get that appraisal comes back. One of the things the CD now clearly says on it, future ability to refinance. This is David's, what do certified financial planners always say? Future results
or past performance is not indicative of future results or future performance. Yeah.
Well, that's what grocery stores are saying right now.
In our industry, we have a disclaimer on the closing statement that says your future value may not be what you paid for this darn house.
Yeah. Well, and that, again, Dave, I don't know if you heard, I've got clients, lenders and realtors, they'll send out stuff, like a lender will send out monthly to clients he's dealt with in the past to keep up with them in case something happens. Interest rate updates, and also appraisal updates. And many are getting updates. Your house is worth X amount, which is less than what you paid for it. Okay. Well, that's inevitable. And people, especially money managers who have achieved wealth over the years and can buy these nice houses, look at that and they kind of take it personal, like, huh, what me? And so it's kind of fun. And some of them are my friends, obviously, that I work with, but you explain, I'm a realtor. I bought this house, the one I'm living in, about 2 months before the market tumped back in 6 or 7, whatever year that was. But yet, doing great, right? Housing value, things recover. You hang in, you go long term, which was your point. And, if you're going to flip, it's different. But I think it's just been an interesting, not a 2008 scenario, but it's been a very interesting inflation, interest rate, yet people move to the area, create demand. days on market have gone up, but gosh, what an interesting dynamic we're in. One, I've been doing this a long time, and I've been buying houses a long time. I have not seen anything like this. This is just a weird, firestorm of economic numbers that I don't think people have dealt with before.
No, I think that's exactly right. And I think, we go through these long periods, and we really have since '08, aside from, a couple of little speed bumps of everything. It just continues to move higher. And, I see even with clients, we get spoiled in, here in the DFW area because our economy's been so strong locally, our job growth has been so strong. And, obviously the number of, new people moving in from out of state has, kind of shielded us from, what we've experienced or what other people have experienced in different parts of the nation. And, this year's been tough all the way around, not only investing, but, as you guys have been talking about in the home markets too.
Yeah. And if you want an idea, if you're listening to this and you want an idea what we're talking about, go to a Dallas Stars game when the Detroit Red Wings are in town. It's 75% Red Wing fans in that arena. And that's exactly what David's talking about. The people are moving here from all over the United States, and for that fact, the world. I mean, they're coming here from all the different countries. And so our economy, I think, is a little different than, maybe Sault Ste. Marie, Michigan or something like that. You know what I mean? So that's what's going on here. It's been a very different dynamic where the national headlines read inflation and interest rates and housing is in trouble and blah, 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 blah. Well, people can read that and then they take that to heart. And our message on the show has always been talk to somebody locally about the market, about your market. And in this show, talk to somebody locally about your wealth.
Yeah. And I think that's the key driver, whether we're talking about, your wealth and your investments and your financial planning, you're talking about, your home and where you're going to live is, gather the information and make yourself an informed individual. But, you got to really seek out that local expert advice to see how it all relates back to your personal situation.
And can you give out your phone number again in case anybody watching or listening wants to call you?
Yeah, absolutely. Number here at the office, it's 972-499-8273. Again, 972-499-8273. You can find us on the web. It's CavinessWealth.com.
Wonderful. And Thom, any closing thoughts today on interest rates or wealth management, your experience that you could help maybe our public, get through this?
Well, I think my biggest word of wisdom is buy low, sell high.
And let it be. Okay, I get it. That's awesome.
All easier said than done, too.
Yeah, exactly. It's a show and a 1, 2, 3. Well, David, thanks a bunch for being here, bud. And I'm sure people will call you. I probably will call you. So thanks for being here. And I just want to thank everybody for joining us for this good 45-minute chat about interest rates and wealth management. So my name's Alan Pace.
And my name's Thom Hulme.
Thanks for joining us. We'll see you next time.
Thanks for having me, guys. I appreciate it.
You bet, Dave.
Bye-bye.